Good morning, ladies and gentlemen, to this rather chilly morning in Gauteng. I hope it's warmer where you are, or that you at least have something warm next to you. Thank you very much for joining us. I'm Pierre de Klerk from Apex Investment Consulting, the sister company to BCI. I'm hosting this morning on behalf of your regular host, Eugene Brock, who's at another conference. He'll be back next week. We're very honored to be joined this morning by Gary Hill from Martello Asset Management, Jersey-based equity and multi-asset specialist investors focusing on high-quality companies in fairly concentrated portfolios. We are also joined by Andrew Clifton from T. Rowe Price, who are value managers and who take quite a differentiated approach to value investing, as many of you might know. So welcome, gents. Thank you for joining us, and thank you for your time this morning. I think by way of introduction to the session, I will say that in South Africa, we've been fairly focused on our elections over the last week, which went quite smoothly from a process point of view, and now we are focused on the aftermath of that and the next 2 weeks of coalition government forming. It's interesting to see that in India there might be a similar process underway, if I understand it correctly. So I think to the audience I would like to say, let's for the next 45 minutes zoom out a bit again and reflect on the fact that we are a fairly small and open economy, and there are this whole global world that influences us from an economic point of view through growth and inflation and monetary policy. And it's also this whole global investment market that we can invest into. So on the one hand, we are influenced, but on the other hand, we can substantially access these other markets, and therefore they are critically important to our investors. So I think that's the background. We're zooming out to a global view, and we're very much forward looking to determine what's in store for the rest of the year for us and beyond as the next cycles develop. So I'm going to hand over straight to Gary from Martello. I'll leave it to the speakers to introduce their own topics. And Gary, you've got until about 20 past.
Great, thank you, Pierre. Good morning, everyone. Can you see my slides okay, Pierre?
Not yet.
Not yet. Okay, let me try again.
Reshare it. Yes, we can. Perfect.
Fine. Okay. Thank you. Good morning, everyone. Yeah, the topic of discussion here today is very much about the strength that we've seen in equity markets so far this year, despite the lack of monetary stimulus from rate easing, which really was expected, I think, 5 months ago to have started by now. What's caused that, and can the conditions that we're seeing right now, which have propped up and really supported equity performance this year so far, can they continue into the second half of the year? If you want to put a label on this environment, as some people like to, then you could call it a Goldilocks environment, not too hot, not too cold. The macro picture is developing constantly. We think mostly in favor of the idea that equity performance can continue to be good for the remainder of the year, notwithstanding the fact that there's going to be a certain amount of hurdles and our own elections in the UK and also in the US to tackle later in the year as well. Just to recap at the start, these are some slides we used at a boutique's weekly webinar in February, where we really highlighted the degree to which equity market performance had been dominated by a small handful of stocks in 2023, and how 2024 was also starting with a very concentrated degree of performance from a small number of companies, reaching extremes in terms of performance relative to what bond markets were doing at this stage of the cycle, and it was very reminiscent of a period that we'd seen in other market rallies, for instance in 2009 coming out of a recession, but also the bubble territory of 1999, where we just felt that valuations themselves had become quite lofty, but the degree of concentration of performance had become very significant and probably unsustainable. So as a result of that, we were sort of examining, what was causing this? Was it justified? And to a certain extent, I think some of the domination of those Magnificent Seven stocks could be justified by the way that their earnings and their sales had grown during 2023 and the forecast for that to continue into this year. So the valuation of those companies was extreme compared to the index. We've seen that before, but to a certain extent, some of that expectation was possibly justified by the very strong earnings that we saw last year, and that's also continued into the first quarter of this year as well. But the homogeneity of that group has split significantly since then, and we're seeing some dispersion of performance coming through, which we also expected to see happening as well. The hurdles that they'd set themselves in terms of forward growth rates of earnings and sales and their profit margins, which were expected to increase significantly going forward, we felt were going to be problems for them to overcome on a year-on-year comparison basis as we moved into this year. And we're starting to see some of that happen. Having said that, we've also seen some very strong continued performance in terms of earnings from those companies. But the main factor that I would draw attention to actually is this slide here, where, clearly on the left-hand side, there's been an improvement and an acceleration in terms of the profit cycle in the US. And the table on the right summarizes the performance of sectors during the first quarter in terms of their actual earnings and revenues versus consensus forecasts. And you can see that on the bottom left, 78% of companies in the S&P beat on earnings, which is a considerable achievement, but also quite high comparative to the historical average for that. So it was an exceptional quarter for corporate earnings in the US. The revenue beat was in line with historic averages, so no significant changes there. There were some depressing figures in that table, which brought that average down to its normal level. But the overriding picture and message from that was that, very strong first quarter, but also that some of that earnings beat and that improvement was widening out across different sectors and wasn't just dominated by technology and communication services, which really had been the driver of those expectation outperformances in the second half of last year. So we see this as a positive. And we expect this to continue as the year goes on, and we'll talk about that further as we go through the presentation. So the concentration effect was still very dominant in the first quarter. You can see from this slide on the left that this is the breakdown of the returns of the market in the S&P 500 for the first quarter going into May. And also you can see that actually the positive sign that we see here is this red area, which shows that this is the contribution to return made by the non-Magnificent Seven stocks, so the 496 other stocks in the index, opposed to Amazon, Meta, and Nvidia and Microsoft, which, I think this has been on the back of some very, very strong and healthy earnings data from those companies, which perhaps wasn't quite as expected as we went into the first quarter. And the earnings growth data we can see on the table on the right-hand side supports that as well. So it's coming through now in terms of improvements and above expectation returns from a number of different sectors in the US economy, which we see as a healthy sign. And it's backing up the call that we made also in May, which is why the broadening out of this rally could continue, and that would give length and support to the ongoing performance of the US equity market as the year goes on. So even though those big companies have dominated so far this year, as you can see on the right-hand side, Bank of America's forecast is for the rest of the market to actually contribute a lot more into the second quarter of this year, and then perhaps overtake in terms of the relative contribution towards growth from the US market as the year goes on into next year as well. Also indicative of this is the forecast from JP Morgan in terms of the forecast for earnings growth across different sectors in the US as this year goes into next year. So just more confirmation of the belief that this broadening out trend that we're seeing is happening, and it's going to continue to happen as the year goes on. And that's taking the the strain off the lack of monetary easing that we've seen in the US and other markets in the developed world over the last 4 or 5 months. Just recapping further again, in the conference in May, we also talked about the growing consensus among forecasters that this leadership change would develop further. And it's really based upon certain catalysts happening to allow that to continue and to support it. Improving global economic growth. We're seeing evidence of that coming through, not just in the US, but also in Europe now as well. Supportive monetary easing. That hasn't really happened yet from an interest rate point of view. Bond yields have been quite resilient in terms of staying in this sort of 4 to 4.5% level. Obviously waiting for clarity and indications of when that easing cycle will start in the US. We expect it to start in Europe this month, possibly in the UK as well, or perhaps next month, depending on election priorities as well. An upturn in commodity prices. We have seen that happen this year so far. Commodities actually, as a basket, have been one of the top performing sort of asset classes in the world so far this year across many different segments of that area, including agriculture, but also in industrial metals as well. And also a softer US dollar. The dollar has been fluctuating this year so far. It's shown periods of weakness and strength. Nothing really as a strong trend just yet, although we are starting to see a little bit of weakness appearing again at the moment. So I think those conditions are coming into play, and they'll develop much further as we go into the second half of the year. And what that would mean for the global economy is that it would lead to a much more favorable sort of cyclical conditions for ex-US companies for their earnings for the remainder of the year. Starting from a relatively low starting point in some cases, as the slide on the right shows, certain parts of the world, including large parts of Europe, have a pretty low sort of starting point in terms of expectations, coupled with quite low valuations as well. And typically as well, the earnings beta to the global trade cycle has historically favored Europe and many other non-US markets as that improves, and we're starting to see evidence of that happening as well. So in terms of sector leadership, just more evidence of that really. This is a chart which shows that up until the 10th of May for the year so far, that it hasn't just been about information technology and consumer discretionary and communication service sectors, even though on a longer term momentum trend that they're still quite strong. There's been pockets of outperformance on the shorter term basis from other sectors in the US, and that's coming through on the earnings that we're seeing as well. Excuse me. So just perhaps a chart to confirm that further. This is a 6-month chart in dollars looking at the performance of developed market equities over that time period, up 15.8%, so quite strong. But what we're seeing here also are the relative performance of different sectors outside of the standard ones that we've been looking at. Gold mining shares, water, the First Trust Water ETF, financials, etc., have all shown strong performance during that period. Certainly a pickup in the last couple of months as well, based upon the earnings season that we've seen and the strong delivery of results from a number of companies in those sectors. So just again, confirming that the leadership isn't in the hands of just a small number of companies, but the evidence is there now that this is starting to broaden out. So in terms of the continuation of this into the second half of the year, what do you mean by a Goldilocks economy? Well, effectively, it's one that's warm enough with steady economic growth to prevent a recession, but growth isn't so hot as to push it into an inflationary status. Now, clearly, inflation is the main macro indicator, which perhaps hasn't been as favorable so far this year, although signs are that it's beginning to cool as we go into the second half. Which will allow, obviously, the Fed to consider the timing of its first interest rate cut. But also on top of that, what we need for this environment to continue are a certain number of factors as listed below. So a low unemployment rate, asset price inflation, low inflation, lower descending market interest rates and steady economic growth. Now, we don't believe that we need to have all of those together at the same time. I think that would be probably a little bit unrealistic, but the trend certainly is in favor of many of these at the moment, and the direction of travel for others is also improving as well. So on the first sort of point in terms of employment, that's obviously been very resilient in the US up until recently. We are starting to see an increased number of, well, actually a reduced number of job openings and slight increases into the unemployment number on a weekly and monthly basis. So it is starting to soften at the margins, which is, I think, what you might expect given this high level of interest rates the US economy has been bearing for 18 months now. And that's obviously been a positive for the bond market, particularly in the last couple of weeks, which is starting to show signs of heading lower in terms of yields. I think the possibility of a no landing scenario, which is one which was perhaps peaking during April when we had the sort of a -4% month for equities, consideration that perhaps, you know, some of the Fed governors were talking about the possibility of another hike rather than the possibility of pausing further or easing. So I think that had an impact on sentiment during April. Some of that is starting to cool off. I think as this year goes on, the percentage sort of swing between you know, hard landing, soft landing, no landing is going to go further in favor of a soft or hard landing scenario, given that some of the data we've seen from the US over the last couple of months is starting to lead that way. And I think this no landing scenario is likely to fall further, which again supports the idea that the Goldilocks, not too hot, not too cold scenario is in play. Apologies for so we're just talking here about the employment figures. We're seeing the unemployment rate lifting off from very low levels, but again, not screaming higher. We're talking about a gradual increase in that number, and it's not affecting confidence too much. On the other side of the pond, in terms of Europe, deflationary forces are still quite strong. We've seen quite a good reduction in terms of CPI data in the UK. And even though economic data in Europe is improving, the CPI data there is trending in the right direction as well. So again, from an inflation point of view, we think that the direction of travel is quite positive at the moment. In terms of the impact that's had on bond yields, this is a chart looking at a number of different markets: Germany, US, and the UK. You can see that rates peaked, particularly on the short end of the curve in the middle of last year. Started trending downwards into the early part of this year. And this sort of resilient interest rate scenario has meant that yields have crept back up again. So this market outperformance has taken place in an environment where it hasn't been supported really by a reduction in bond yields yet, which I think proves the fact that the underlying driver of equity performance this year has been the very strong corporate results that we've seen and the ongoing improvement in corporate health in developed markets, which, you know, again, is a positive sign. So on the other factor that we're talking about, sort of good economic growth, positive again in terms of the recent uptick in terms of the macro surprise data out of the US. There's been a period during the last 12 months where some of that data hasn't been so strong. We are starting to see a little bit of an improvement there. But it's a mixed picture. It's not all about manufacturing or services. I mean, there were months when some of the order data comes in a little bit weaker than expected. But I think that, again, from a low point, we're starting to see an improvement there, particularly in the US and also in Europe as well. I think this is an important sign for us, given that we have an overweight to Europe in our global equity fund. And we've really been waiting for this to sort of happen over the last few months, and it's starting to show improvement. I think linked again to the tourism and service sector, where we're seeing strong recovery, particularly in the sort of tourism-related countries in Europe, but also from a manufacturing point of view, Germany, France, Spain, Italy, in terms of their production areas and their exports, particularly to emerging markets as well. So again, a positive picture that we're seeing there. Which is supporting, I think, the relative performance of European shares to the US market over the last 3 or 4 months. I think another important aspect which we are considering, and I think you need to take into account, is the real importance of share buybacks. Over the course of the Q1 earnings, we saw a lot of companies in our universe and in our fund that announced increases in share buybacks, and also this was happening in companies that perhaps previously hadn't considered this, but their use of cash clearly is quite an important message that they're giving to the market, but also they're using this to buy back shares, and it's causing a shrinking of the available global equity market, particularly in some of the most loved stocks. US buybacks have been the dominant buyer of equities for the last 25 years, and that trend is not stopping. In fact, if anything, it's increasing further. Up to the point where we're going back to a 2018 high this year and possibly higher next year as well. So that's an important aspect to consider, and we're seeing that broadening out as well into Europe. Just on the earnings side of things, the tailwind that we saw and talked about previously, again, this is just further confirmation of that. Normally by this stage of the year, analysts are starting to sort of revise their earnings outlook for the remainder of the year. What we've seen so far is actually that hasn't been the case. If anything, earnings revisions have been trending upwards since the middle of the earnings season in Q1, and not following the historical path lower, which normally happens by this stage of the year. So it suggests that the market is perhaps a little bit wrong-footed in terms of their outlook for the remainder of this year, and I think a lot of that is down to the fact that the broadening of the performance has led to revisions upwards for many stocks in different sectors to the ones which have been sort of leading the market for the last 12 months. And as you can see, that the correlation between earnings and the performance of the equity market is very strong. And going forward, we would expect that trend to continue, which again supports the idea that there's further upside in the US market, but also in non-US markets as the year continues. And just going to valuation. Clearly, the dominant sector there in terms of value is still the tech sector, and perhaps also communication services and some of the consumer discretionary side. But stripping those out and looking at the relative value in sectors outside of those, there are pockets of real value coupled with strong growth that are attracting us to sectors other than the ones we've mentioned before. And I think that's really the key to the navigation of this market going forward, is the determining which of those sectors should perhaps be used in portfolios and used in your models to actually achieve that high level of growth from a lower valuation base for the remainder of the year. So just in summary, a couple of quotes here from different analysts that we look at. I won't go through the whole thing. The broad economic picture, therefore, remains quite positive for the time being and is likely to remain supportive as we head towards the summer. And also, I think the idea that this earnings broadening and the diversification of returns across different sectors should continue as the year goes on. Just bearing in mind all of that, so our current positioning in our global equity fund is that we have a slight underweight to the US. We're at about 60% relative to 68% in the index. The balance of that is in Europe. Europe at 25%, Switzerland and the UK at another 12%. Our current sector overweights are financials, industrials, communication services, and we're slightly underweight tech. But we're picking up our tech exposure, not just in the US market, but also outside of the US and Europe as well. And leading performers in our fund year to date include stocks such as ASML, Novo Nordisk, Rolls-Royce, and SAP in Europe. And in the US, Garmin, Alphabet, Netflix, Amazon, and Berkshire Hathaway, which have all had pretty solid runs this year so far. So yeah, I think I'll stop there. Our broad message is that the conditions we think certainly still exist in terms of supporting the idea of further performance from equities this year, and I think that'll be reinforced further and supported by interest rate cuts as they come along in the second half.
Thank you, Gary. Some very interesting slides, and I think the broadening out of the performance drivers is important for us from a portfolio construction or multi-manager point of view, because it raises the point that active managers might play a stronger role in our portfolios for the remainder of the year and going forward. So I think that is something to take into account. Andrew, you're welcome to share your slides. And I also want to, remind the audience that you're welcome to post questions in the Q&A box, and we will have some time at the end to look at a few questions. We can see your slides, Andrew, so you are welcome to go for it, and you can take your time until about 22. You've got 20 minutes.
Thank you, Pierre, and good morning to everyone. In the next 15 or 20 minutes, I really want to talk about really two things. Firstly, value investing in a new age and really looking at what has changed. And then also just spend a few minutes talking about the T. Rowe Price Global Value Equity Feeder Fund that I think many of you will be familiar with, but hopefully I can update you on how things have been going. So firstly, if I just turn on to the relevant page, I mean, one of the things that undoubtedly has changed is that we are in a new age of higher rates. Capital, again, has a real price. I think the important point to emphasize is that this is, in a sense, a return to normal. I think as time goes by and as real rates and nominal rates remain positive, there's an increasing appreciation that really the last 12 years or so was the abnormality from a long-term perspective. It is not normal to have a negative or zero interest rate. And a move to positive rates really has three main impacts, generally very supportive to value investing. The first is the general point that a positive cost of capital, a time value of money, does encourage the adoption of a tighter valuation discipline alongside the ongoing importance of fundamentals. I think in the last 10 to 15 years or so, fundamentals have been so dominant. It has all been about the growth potential of the business, with valuation very much in the backseat. But I think now valuation in general is becoming a more important toolkit in investors' framework. Secondly, the specifics of valuation are changing. It is more important to have shorter term, more predictable cash flows. The market is less willing to pay higher valuations for more distant, less visible cash flows, and certainly will be less tolerant of loss-making businesses. And then the third point is that specifically financials, both banks and insurance, clearly mainstays of the value universe, are very much beneficiaries of a move to higher rates. The other positive backdrop, I think, is that we could be well on the cusp of a very strong commodity cycle for the next 5 to 10 years. And here we show the long-term lesson from history in that not only are higher rates generally supportive of value outperforming growth, but also whenever we have a commodity bull market, as you can see on this graph in the 1970s, and also in the early years of the current century, that was a positive backdrop for value investing. So what are the key determinants of the environment for the next 10 years? Firstly, the commodity complex, I think, is going to be a very important factor. We're seeing this clearly already, as you'll be familiar locally with the outbreak of a lot of corporate activity, a lot of M&A activity. But we do feel this is going to be a sustainable trend. Secondly, the outlook for investment generally is going to be a lot more expansionary and inflationary. And then thirdly, macroeconomic influences as well. So let me quickly take each of these in turn. Firstly, on the commodity complex. And I think one of the key messages, or one of the key distinctions that we have, is that we feel energy productivity is really set to decline from here. We have been blessed for the last 10 to 15 years by improving productivity in energy. Basically, that has encouraged increasing drilling, increasing activity, but actually it has been a negative backdrop for the energy sector. What we're starting to see now is a decline in productivity. Certainly in natural gas, we feel it's now starting to happen in the traditional oil sector. And as productivity declines due to both technological limits, but also the limits of exploration, then that will be exerting upward pressure on the cost curve, on the oil price, and we feel that this is a positive backdrop for the energy sector. And I think the key point as well is that although the green transition is going to be a very important feature for investors over the coming decades, and I'll come back to that in a moment, the traditional energy sector is not going away. As we can see on this page here, even under different scenarios, and the footnotes give you the details, but even under the most optimistic scenarios of a transition to a cleaner, carbon-free world, traditional fossil fuels will continue to be a key part of the global economy. And if we are having that inflationary backdrop due to lower productivity being a continual pressure, then that has quite a wider impact as well upon the global economy more broadly, but also commodity markets generally. 40% of the input costs of most commodities are directly related to the price of energy. In addition, we are now starting to see a really tight labour market emerge for many commodities, largely reflecting the historic pattern of graduates declining in the mining industries 10 to 15 years ago, and we now don't have that depth of talent coming through. So labour cost inflation is becoming more important. And also another inflationary factor that is certainly becoming more evident are the social pressures within the ESG paradigm. We've recently seen the closure of one of the world's largest copper mines in Panama, which were essentially due to social pressures. It was very profitable. It was a key contributor to employment and the government fiscal policy. But essentially, the local population were up in arms about the structure that was in place, and production there has halted. And across the mining complex, we are seeing mining companies struggling to meet their production expectations. The second topic I just want to quickly mention is the outlook for investment. We're really moving from a decade of very low levels of investment to one where there are increasing needs for higher levels of expansionary spending. This chart shows that across many industries, and here we show for the global oil industry, but also the mining industry, how for the last decade, management teams have not been investing in certainly expanding their activities, and in some cases, in even maintaining their existing infrastructure. And they were very much listening to the message coming from the market in that investors were rewarding companies that returned capital to shareholders, and companies were not being compensated or encouraged to invest in their ongoing businesses. That clearly is now changing. The world is now facing a far more positive backdrop in terms of commodity demand, but it will take time for this historic underinvestment to be corrected. This is really, though, a major challenge, because at the same time, there are dramatic needs for new capital investments, and not least the shift towards clean energy. And on this page, we show the forecast from the IEA, whereby from a position in the last 5 years of the previous decade, where we had total spend of the order of just over $1 trillion on clean energy investments, on an annual basis, within a few years, that level needs to be in excess of $4 trillion. So we are looking at dramatic increases in the level of investment across many areas where decarbonization needs to occur. And the critical thing for an active value investor is that we really are in the eye of the storm here, because most of the carbon emissions that we are trying to abate in the world are generated from a fairly narrow range of sectors. As shown on this page, over 80% of carbon emissions come from 4 sectors that account for less than 20% of the global market, but they are very much value-oriented sectors. So this is both an opportunity, clearly, for investors if we can find those companies that are well positioned for this growth opportunity, but it's also a threat. Many companies will not have the right technology to invest. Many will be caught offside. So active investing is very much the approach that one needs to adopt. And then the final point I will mention is just very briefly, although we are focused on stock-specific insights, we cannot ignore the macro world around us. And I think what we are faced with is a world where debt levels are already high, even without any recession as yet emerging to any recognizable extent. For now, investors are tolerant of high levels of debt. Were this to continue to deteriorate, we could well see greater tension emerge in bond markets, which would create further upwards pressure in rates. And I think another general inflationary element that we would highlight is across the world in recent years, we are starting to shift away from what we can call the efficient frontier. 10 to 20 years ago, the focus was on about shifting productive resources to where they can be most cheaply produced. Now there is a greater focus on security, on reshoring, on making sure that supply chains are robust. So we're seeing duplication of investments, duplication of productive facilities, and this is more inefficient and is by its nature more inflationary. And in closing on this section, although we have all of these positive tailwinds beginning to emerge for value investing, we do feel that valuations still remain very attractive. And indeed, although there are some signs that market dynamics are beginning to change, even in the current year to date, value is modestly underperforming core benchmarks. Last year, in most regions, value performed extremely well. The one exception was the US marketplace, which, given its dominance in global indices, meant that at a global level, value underperformed. But in Japan, in Europe, and most of the regions, including emerging markets, value did outperform. But we are still in a position where the starting point for an allocation to value is very favorable. This page shows the premium that has historically been awarded to growth companies relative to value companies over the last 45 years or so. And we still are over to the right-hand side of the series. Now, clearly, valuation in and of itself is not a catalyst, but hopefully, as we see these longer-term trends emerge, that could encourage many investors to realize the potential within a value allocation. And as Gary, in his presentation, highlighted, there are changes going on within the earnings pattern of markets, within the performance pattern of markets. And one very interesting aspect this year is as we look at the earnings expectations over the coming quarters, not only are value companies in the US marketplace expected to see an accelerating rate of earnings growth, but actually by the fourth quarter of this year, value companies are expected to exhibit higher rates of earnings growth than growth companies. And now this is largely due to the evolution of comparative bases as we go through each quarter, but that in itself may cause investors to question why should value companies continue to be at such a discount to growth companies. Let me just, in closing, spend a few minutes on our global value equity feeder fund, which is gold rated by Citywire. Essentially, our investment philosophy is to exploit controversy in markets. Many investors dislike companies with problems where there is uncertainty, and we need to work with our analyst team to basically use insights to assess whether perceived problems and controversies can be resolved, and if they can be, to establish the asymmetry of opportunity that we're faced with. There will always be downside, but we're interested in how appreciable could be the accompanying upside if our analysis proves to be correct. And I think one of the strongest competitive distinctions of our fund versus other value managers you'll be familiar with in your marketplace is that we look to do this across the value spectrum. Different types of value are effective at different times. We invest in both higher quality defensive companies, but also more cyclical and deeper value companies. This enables us not only to play the different stages of the value cycle that emerge in the marketplace, but also it is really reinforcing the benefits of our broad platform with around 100 experienced equity analysts giving us insights across their universe. Where are we seeing the best opportunities currently? We're most overweight those traditional value sectors of financials and energy. In financials, we still feel there's a lot of opportunities in both banks and insurance. We are finding increasing opportunities outside of the US marketplace, although the US financials continue to be a core holding for us. Within energy, we are very strong believers that the world has changed, and a world of declining productivity is a very positive backdrop for the traditional manufacturers. In terms of our big underweight, perhaps no surprise, it is those more traditional growth sectors of IT and consumer discretionary. But even within those sectors, we find good opportunities. Within IT, it's especially focused on the more cyclical areas of technology, particularly semiconductors, but elsewhere as well, occasional opportunities outside of the usual hunting grounds. And then from a geographic perspective, we are most underweight the Americas, particularly the US marketplace. Given its dominance in the benchmark of close to 70%, we still have a very meaningful allocation to the US, and many US investments are some of our best value opportunities, not least in areas like financials and healthcare and utilities. But outside of the US marketplace, even still, we can find good opportunities in Japan, particularly in the small and mid-cap space, and across Europe. Good opportunities continue to be present. And in closing, just to highlight that our performance pattern is generally more robust and less volatile than you'll see from other active value managers. That is really reflecting the fact that we are utilizing the broad value spectrum. We have generally kept up or just been short of the core benchmark since inception in 2012. But against our value benchmark, against our value peer group, we have generated over most periods a good level of excess return. So in closing, we do feel that the world is changing. We are in a new age. The outlook for inflation and rates is very different. We're at least faced with a level playing field for value investing. The valuation of value is still attractive. This is still a good time to begin to change your allocations, which may be more heavily weighted towards growth than perhaps you feel comfortable with. And in terms of how we invest, we do feel that investing across the value spectrum really is a far more robust way to deliver a less volatile performance pattern, and it's one that we continue to implement with confidence. So with that, I will stop, and I think Gary and I would be delighted to take any questions that you have.
Thank you, Andrew, and thank you, Gary, for your interesting presentations. I think maybe a first observation from my side as a consultant or multi-manager is that when an audience or listeners listen to a webcast like this, we have a value manager and you have a manager with a more of a quality and maybe growth leaning. A natural question is always, do we need to pick between these two? And I think I just want to re-emphasize that from a multi-manager point of view, that heavily kind of has risk management of a portfolio as a theme. We strongly believe it's not a black or zero or black or white, black or red kind of roulette type of approach to this, where it's a zero-sum game. So, from our side, based on our research, we also see the broadening out of the drivers. We see the improvement in the global manufacturing indicators. We expect there's going to be a turn towards the more cyclicals, and we capture, or we realize we need to capture that most strongly through value. And therefore, we don't focus on the manager, but we think about what does a manager and his style bring to the portfolio. And then on the other side, we still see some, although people have, talked less and less about recession risk, we still see an inverted yield curve in the US. We still see rates longer for, higher for longer. And we know it works with long and variable lags, and we can't write, even if the base case is a soft landing, we can't write recession risk in the US off completely. And then we realize that quality as a style is the one that is more defensive if anything goes wrong, firstly. And secondly, it's the style that exposes you to the tech theme, which you also, for the reasons that Gary has set out, can't discard. So I think I just want to mention that whenever we listen to these things, it's not about picking between different managers with different styles, but to say, listen, how do I think about my portfolio probabilistically in terms of what might happen in the future, and what does different managers and their styles bring to my portfolio, and how do I blend them? So maybe just in the last minute or two, one or two questions. Maybe firstly to you, Andrew. I saw on your slide that you allow yourself exposure to emerging markets up to 10%. Can you maybe just detail for us where you are in terms of your EM exposure currently, and very briefly how you think about EM going forward?
Yes, I mean, it is very much an opportunistic approach, up to 10%, as you say. We have a superb emerging markets franchise here at T. Rowe Price. We have an emerging markets value strategy as well. So that is a great source of potential ideas. Currently, we have exposure to India, but also Vietnam. Now, we do very carefully control these individual position sizes because they are, by their nature, typically higher risk. And I think just the experience of last week with elections in not just South Africa, but also Mexico and India, it illustrates that in emerging markets, sometimes those bigger macro political factors are bigger drivers than typically one sees in developed markets. So we're aware of the risks, but there certainly are opportunities, and we are nimble and look to selectively take advantage of those.
Any exposure to China specifically at the present time?
We have recently added to one Chinese name in the internet space. China is incredibly cheap. I don't need to tell the audience that. It is about balancing the risks and whether the stock is cheap enough. But there are now situations, or certainly as we stood 6 to 8 weeks ago, there were situations where valuations were incredibly attractive, and just one position is in the portfolio within the context of 80 to 100 names. So we're comfortable with that level of risk.
Thank you. We certainly share the view about the cheapness of China, but I think there's a whole host of other factors one needs to take into account. Gary, turning to you, you mentioned you're underweight the US and you're overweight to Europe. Can you maybe give us some examples briefly of the holdings that you have in Europe, and the reasons why you think those are particularly good opportunities?
Yeah, I'll take the European side first. Our process is bottom up. It's bottom up. It comes through a 3-stage sort of screening process for inclusion in the portfolio. The stocks that we hold there really perhaps they tilt towards where we see Europe having strengths. So we're talking about industrials. Some of the banks that we own are in Europe. Nordea Bank, UBS. We've been owning since the merger with Credit Suisse, and we like the growth outlook for that company, coupled with the dominant position it obviously has now in its local market, but also globally from the wealth management point of view. And it's addressing the issues of the regulator in Switzerland quite well. And I think the retention of capital, etc., they're already providing for that. So we see that as being a great recovery play from some sort of quite low depths linked to the sort of banking crisis that we saw last year. Other than those, we have ASML on the chip side. We have Airbus as one of our largest holdings. We see it obviously dominating the space at the moment. Airbus's biggest problem is that it can't assemble planes quickly enough to meet demand, and its order book stretches out into the next decade. So even the CEO of Airbus believes that a healthy airline market requires Boeing to get back to full production, because they're taking the strain at the moment in terms of orders, and they can't meet them, and that's having an impact on sentiment towards the company, I think, rather than the earnings of it. So we see that as a great growth story, but it probably requires Boeing to sort of sort its problems out as well. Stellantis, which is a Dutch-based but Italian sort of manufacturer of vehicles spanning the US and Europe as well. We like that from a valuation point of view. It's very attractive, and it's also got an incredibly strong balance sheet and is highly profitable in an area which is very competitive at the moment with a lot of margin pressures, etc. So yeah, our European focus definitely tilts towards the manufacturing side, the industrials, Veolia, Vinci, companies with a global footprint, but which are based in Europe.
Maybe on that point, I wanted to ask Gary, my understanding is that you mainly focus on companies listed in developed markets, for put it that way, but clearly a lot of the earnings will come from the emerging markets. So do you have a sense in your portfolio what the proportion is of economic benefit that comes from the developing world that flows through?
That's a very good question. It does vary a lot across the stocks that we hold. There are clearly some which are a little bit more sort of skewed towards their domestic market, but not many. And those which are in the portfolio have a high degree of global earnings exposure. I think in terms of emerging markets, I think the healthcare stocks have a much larger tilt towards that at the moment, and some of the industrials as well. I would probably put it at a figure of sort of 10 to 15% in terms of the ratio. We do some work on it, and we haven't updated it for a little while on the portfolio, so it's something I could come back to you with, definitely.
Okay, thank you. Sure, we need to wrap up. We're almost out of time. I just want to make another point that if you listen closely to the two speakers, you would have heard that both of them are fairly positive on financials as a sector. So I also just want to make the point that you can have managers with different styles, but on a sector basis, it's not mutually exclusive. You can have managers of quite different styles actually finding value in the same sector. But thank you very much for the insights provided, Andrew and Gary. There was no questions coming through in the question box. If any late ones come in, we'll send it through to you. But for the audience, I just want to mention that both the managers have funds that have feeders through BCI and are available on most of the global platforms. So if you have interest in the funds, you can certainly access them through BCI. We're very grateful for the managers to allow us to have feeders with them as well. So thank you very much for your time. Thank you for the insights. We're continuing next week with another boutiques on Wednesday. We're back to a 8:30 start. And next week, it'll be GINS Global Index Funds and Methodical Investment Management on the agenda. And your regular host, Eugene, will be back. Thank you to the audience for joining us. And again, thank you to my speakers, Andrew and Gary. Thank you very much. Enjoy your day.
Thank you.